my guest now, Roger Montgomery. He's an independent strategist joining me now here live from the set in Sydney. Roger, good to have you with us today.
Thanks, Oriel. Nice to be here.
I know you are absolutely, you've told me many times, a longer-term player, but I'm sure that you've seen this, these falls that we've had on the market today.
Sure. Not surprised. I think I've been saying now on your program for some time that the market appears to be overvalued. In fact, I wrote on my blog back in December I thought the market was about 15 to 20% over its intrinsic value. It's down 6% since I said that, so it's neither here nor there. I think the short-term moves, as you rightly point out, to me don't matter that much. What's interesting though is that the good quality businesses that I tend to follow and comment on, very few are trading at discounts to their valuations this year. Some of them are at discounts to their valuations for next year and the year after, but the really cheap bargains, they're gone.
Not around so much anymore. Now, I know that JB Hi-Fi has been one of your top picks for some time, a number of years now, a couple of years, I should say.
Yeah, I think it was December 2008. It was about $9 when I came on here. And
isn't that incredible?
It's my top pick.
Oh, what a race.
Yeah.
Now, is this stock still are you still adding to positions with JB Hi-Fi? And I guess I ask, tying it to something that's happened today, and that's those quarterly numbers that we had up from Woolworths.
Sure. Look, people tend to focus on macro. It's the most unusual thing, but they're investing in a micro sense. They're investing in individual businesses, yet they make their buy and sell decisions based on macro news, which I think is a mistake. I think what you need to do is you need to look at individual businesses, because even when the economy is going badly, there are businesses that will do well and grow their market share at the expense of their competitors. JB Hi-Fi is an example of that sort of business. It generates a very high rate of return on equity. It has minimal debt, certainly manageable debt. It's entrenching its competitive advantage enormously. You know, every year it comes out, every 6 months it comes out and says, oh, have a look at our gross margins. That's an indication that it's tough out there. We're not able to charge higher prices and so on and so forth. But the reality is they're deliberately charging lower prices because they can afford to. They're entrenching their competitive advantage. They're making it difficult for anyone else to charge the sorts of prices that they can, and that's increasing their foot traffic. They're entrenching their competitive advantage. They're buying market share. If you look at their net profit margin, it's going up. So this is a great business.
So it's still a buy. Where are we now? 2087?
2087, it's not a bargain. Its value is about $19 or $20 this year. But next year I've got the valuation of that business going to $24 and to $31, $32 the year after. So surprise, I'll tell you what most people do. Most people look at the share price and they say, well, Roger recommended it at $9. It's now at $20 odd or $21. It's been to 23. It's had its race. But you've got to forget about the past. You can't invest looking in the rearview mirror. You've got to think about what the business's value is going to do in the future, and the value of this business is going to continue rising. Okay,
JB Hi-Fi is one. I think this is a very special case for this company. You know, when you look at the charts that we've just been putting up, they're incredible. What else are you looking at right now going into 2010 as a longer-term investor, looking at the distant horizons, 2 and 3 years out? Which stocks do you find really attractive?
CSL looks good. I would have said Woolworths, but it isn't. You know, I've got the valuation here actually. Woolworths, I've got its value at about $26.30 this year, $29 next year, and $31 the year after. It's trading at a discount to its 2011 and 2012 valuation, but it's not cheap compared to the current. If you really want a margin of safety, if you really want to go to bed knowing that you're going to do well, then you want to buy at a discount to the valuation today as well.
That's right.
But it is important to buy businesses whose value is rising. Woolworths is one of those. CSL is another one.
Is that at a discount today?
CSL is at a discount to its valuation today, and that's only because it's been out of favour for some time. And why? Because the Australian dollar's been so strong. Another one which has really piqued my curiosity, having come back from holidays, is Macmillan Shakespeare. Now, it's sold off enormously. I think it was down 20% or 18 to 20% in one day a few days ago. And it did that, it may have actually been on Monday, and it did that because of speculation about the outcome of the Henry tax review. But it is speculation. Now, if the speculation is right, then half their business could go. So it is a risky proposition. But if the speculation is wrong, and nobody knows the detail of the Ken Henry tax review yet, and if the speculation is wrong, well, there's an enormous opportunity there because its value is about $4 and it's trading, I think, at around $3.20 when I last looked.
$3.21.
So there you go. So there's an opportunity but there's risk. And I've previously owned that particular company, and I think if viewers go to the blog, I think it was around early December that I said, look, it's a little bit of a worry, this Ken Henry tax review. One of the founding shareholders had sold a big portion of shares. That to me is always something that I'm nervous about. Doesn't necessarily mean anything, but it's something to be watchful of. And given that at that time it was closer to $4, trading around its intrinsic value, then I thought it was better to sell and sit on the sidelines. Now it's down to $3.20. The value is $4 based on what we know, and if there's no negative or adverse impact from the Ken Henry tax review, well, the value is going to rise significantly over the next few years.
It is, and I know that you've mentioned this a couple of times, it is, though, for a high-risk player, that trade by the
higher risk, because we don't know the outcome of the review.
The review.
Once that's known, then we can be more certain about the value and about whether there's value right there now.
All right. Roger, great to have you with us, as always.
Thank you.
Thank you so much for joining us. Roger Montgomery is an independent strategist. Well, stick around. CNBC's Cash Flow returns on the other side of the break with more of Fogarty.